Hey.
Thank you so much for allowing me into your space during this new normal. You know, I'm trying to keep my 6 feet, but I got to talk to you. I had to get in here because so much is going on. Like, we have to have a conversation. You know, a couple weeks ago, the U.S. economy tried to stimulate, you know, the Fed's dropping rates to 0%. So, of course, you know, that caused my phone to just go wild, right? Emails are backed up, phone calls are coming in. All my waiting in the wingmen are now trying to pull the trigger. And so I just wanted to clarify some things. Are mortgage rates 0%? Like, is it time to get out there and buy?
Well, it's time to get out there and buy,
Yes.
but the rates are not 0%.
Correct.
So unfortunately, when regular consumers that aren't in the business, you don't expect them to know everything about the business.
Yeah.
So when the Fed cuts rates, they actually cut the Fed fund rate, the rate that banks borrow money on from the federal government, not mortgage rates.
Gotcha.
Mortgages are affected, right? There's a lag time for that effect to happen.
Mm-hmm.
So when they say that rates are 0%, it's on short-term money. It is. So on automobile loans and things like that, rates will fall. But on your normal mortgage rates that are tied to the bond market, it's a lag time.
The long-term loans.
Yes,
Okay.
it's a lag time before it affects us.
Gotcha.
But it's still a good time to buy.
Always a great time to buy, right? So, you know, Chase Bank has been in the news this week. That's been a big buzz about, you know, just changing the lending requirements. Can you talk to us a little bit about how this COVID-19, you know, the state that we're in, has affected the market?
Well, it's affected the market greatly, and mainly because there's a shift that went on, right? So we had a great economy and it was flourishing, but whenever the COVID-19 came in, and then the president spoke, so sometimes you have to be careful that things actually move the market. So when the president speaks, he moved the market. JP Morgan Chase, Jamie Dimon, he speaks sometimes, he moves the market. I'll tell you how the COVID has affected the market, but let me get back to Chase first.
Okay.
So Chase moved the market yesterday by announcing that effective today, Tuesday, that they're only going to lend to people with 700 credit scores and putting 20% down. Well, what they've essentially done was said, we don't want any loans in our portfolio because we service these. We want to keep only the good stuff for ourselves, right? Which they have the right to do for until this kind of clears up. So they kind of gotten out of certain spaces. They still do every loan available, right? They still do FHA. They still do, you know, regular conventional loans, USDA. They do all those products, but they're saying we're going to go a little tighter on credit until we figure this credit market out, right?
So even though interest rates are dropped, the big thing is the risk is greater because people are losing jobs, and so them lending money now puts them in a bad position, so they're trying to protect themselves.
Yes. And so what happens is, since whenever the shift happened, whenever people start losing their jobs, and the president announced, hey, you can skip your mortgage payment or don't have to pay your mortgage, that right there derailed the market, right? His intention was really good, but the delivery of it was bad, because now you have people thinking, well, I don't have to pay my payment, right?
Never a good idea.
Never a good idea.
Never a good idea.
And they're thinking, I don't have to make a mortgage payment, right? They're losing jobs, they're not making mortgage payments. Losing jobs, I understand there's a financial hardship, but there's some honest people that have the money that don't want to make their payments. What you fail to realize is the people that collect that money, the servicer of that loan, they still have to pay on government loans.
Absolutely.
That payment still has to be paid to the investors on a government loan.
Absolutely.
So when the federal government said you don't have to make the payments, it pretty much shuts your servicers down. So now they have a negative servicing portfolio that they're still paying out on. They're not collecting, but they're still paying out every single month to the investors on government loans. Right? And then the government said, well, we're not going to bail the servicers out.
Absolutely.
So now the servicers are thinking, we're in trouble here. We're in trouble because we're not collecting the revenue and we're putting it out.
Absolutely.
And so there lies the servicer pulling back, and you see other lenders are starting to change their guidelines because the servicer said, we're only going to take these particular buyers. When I say servicer, I'm talking about the person that takes the payments and then pays out the investors that invest in these loans.
Absolutely.
Right? So now they're backing out of the market because they're going, let me figure out what my my liabilities are here
Right.
before I get back in the game.
Absolutely.
And so we need people to make their mortgage payments that can afford to make it.
And that is the part that we don't hear about. So we have much more to share with you. I'm Arnee Harrison. Welcome to the Owner Suite.